Hello. Hi. You showed up right away this time. Awesome. I'm happy to see you guys here. Um, how is everybody? Good? Have a good weekend? I have a few things to go over, and I really am pleased because I feel like here, sorry, just a second. I'm pleased because I feel like I made some changes to class two to clarify EPS and PE and PEG. And I think that those changes really helped you guys because it seemed like everybody had a much better understanding going into class three and thus did not have as many issues as far as understanding class three as we've had in the past. So yay, I'm so excited. Let me see. Okay, everything's good. Awesome. All right, so before I get into your specific questions, I want to touch on a few things. Forward versus trailing growth. That's something that I really wanted you guys to understand pretty well with class three is that trailing growth rate is one thing and can be very useful depending on the business. And a forward growth rate is actually is going to be better sometimes depending on how the business is changing and what different opportunities and threats are on the horizon for it. So I hope that that was after you finish class three. So like with the restaurant, it grew quickly in the past, but it kind of was running out of space to grow anymore without putting a lot more money into it. And then with the car wash, there were some things that could be worked out in the business in order to help its growth in the future. So those are things that I want you to keep in mind on a larger scale for real businesses in the stock market. So those are the things that you want to read up on and understand when you are researching businesses before you buy them. For now, I want you to use analyst estimates that you can find in Yahoo. And you can get to it from the app. You just have to click through a little bit further. And if it's changed somehow, then I'll take a look at it and see. But you just have to click through a little bit further and they will give you the 5-year growth rates, both in the past and the trailing and the forward growth rates. So it'll be up to you to decide which one you want to use for your companies to see which one makes more sense. And you'll get a better feel for that in class 5. That's where we go through the flow chart and be able to decide better whether you should use a trailing or a forward growth rate. Because while you always do want to look to the future for companies, not every company is going to require forward growth rate because sometimes it's not doing anything differently and the past is okay to use. So I hope that that makes sense. Oh yes, and then later on, I want you to read things like once you are familiar with all these terms and these concepts, you will want to use something like Seeking Alpha, which is an excellent investor community. That's what I use for my information. Yahoo is just easier when you're first getting started because Seeking Alpha can be very technical. But now that you are starting to understand all these different terms and what they mean and, all these different concepts here, Seeking Alpha is a great place to find out what other investors think rather than listening to just the biased opinions of Wall Street, which is what you're going to get if you're only using analyst information. So Seeking Alpha is a community of other investors who are just like you, or maybe on a larger scale, but they've been doing it for quite some time, and they're actually just individual or what they call retail investors. So they are just conducting their own research for their own portfolios rather than having an interest in moving the market one way or another, which is what happens with Wall Street and analysts and all that. So I hope that that makes sense a little bit, but you will want to adjust the information that you're using as you become more knowledgeable and as you become aware of what kinds of things you should be looking at as far as how a business will grow in the future. So Let's see. Oh, and you'll see me do, there's a very long analysis of Procter and Gamble in Live that you can download and read. And I go through all of these different steps of all this research for Procter and Gamble, including the part where you read and look at articles and just kind of grab little facts and then base your own analysis around the independent research that you've done. So that's a good read. And it seems really long because I have like some, screenshots and charts and all this stuff, but it's really, if you can just skim it or just like read a little bit at a time, it's really helpful in helping you understand what it is that's important to look at when you are reading articles and things like that. So forward growth rates are very subjective. That's something that you and your partner in class and another investor and me, we could all come up with different forward growth rates, and none of us are wrong because none of us can actually see the future, but we can just make very intelligent, educated guesses to the future. Oh, the other point I wanted to make was a negative growth rate, a negative trailing growth rate does not mean that the company is losing money. It's not the same as a negative EPS. Now, negative EPS means negative profits. A negative growth means that it is growing, that it is earning less this year than it has in the past. So if a company had $1 billion in net earnings a couple years ago, and this year it has 900 million rather than $1 billion, then it would have a negative growth rate because it's earning less than it did before. It's earning 10% less, is that right? Less than it did 2 years ago. So does that make sense? I know it's a little bit, but negative growth rate does not mean negative profits. It just means it's not growing, actually not earning more than it did in the past. So, all right, let me go back and see what I missed. And if you have questions, post them now. All right, awesome, T. I'm so happy to hear that. I did that on my birthday. I redid class 2 on my birthday, and everyone's like, "Stop working." I'm like, "No, this it was fun for me to redo class 2." So that makes me really happy that it helped. All right, good. I'm glad, Yolanda. Motley Fool is awesome. I like Motley Fool because it's a good place to get data and read the articles. And while they are analysts, they do have, they really simplify the information for a beginner. So it's not as technical as something like Seeking Alpha when you're reading articles from Motley Fool. I learned a lot about investing from Motley Fool and Investopedia. And then I started looking at Seeking Alpha, and then I like kind of threw it. I was like, I don't understand this stuff. But by reading the, the articles that had more layman's terms in them, like Motley Fool and Investopedia, then I was able to eventually graduate to Seeking Alpha. And Seeking Alpha is, the comments are a lot of times the best part of the articles. You read the comments from people and they're gold. And a lot of times they're a lot easier to understand than the articles themselves. So start looking at it and just kind of get a feel for things. You'll be surprised at how much you already know just having done the first 3 classes, understanding what they're talking about. And the stuff that you don't understand, that's okay. Just skim over it. And then as you learn more and, read more, and you're always, every time you read and expose yourself to it, you'll get better and better, and it'll feel more and more familiar. So, right. Delta, NA for trailing and forward growth. I would look into that and see why. There might be, there could be a reason for that, that growth. I would have to look into it. I can't think of a reason off the top of my head, but I'm sure there is a reason why there is no forward or trailing growth. Let me see. Only growth rate. Were those trailing forward peg rates in the app? I said growth rate, so I wasn't sure if that was EPS growth or PEG. Okay, PEG doesn't have a growth. PEG is what you get by applying the growth to the PE ratio. So PEG ratio, I mean, you wouldn't really look at how much a PEG is growing. You would look at how much you're always looking at how much the EPS is growing. I mean, there are other metrics you can look at, the growth, you can look at revenue growth and things like that. But for our purposes, we're looking at EPS growth, and that is going to be how much the profits are growing. That's what's important here for this class. Like I said, you can look at other things like revenue and stuff, but that's, really the profits are the most important in my opinion. And that, of course, is an investor preference thing. So ratio is one of the few metrics I ask you to calculate yourself. And that is because it can always change, first of all. Second of all, if you are just pulling a PEG ratio, you don't know if it has been dividend adjusted. You don't know if it's forward or trailing. There's too many factors to not understand when you are doing a PEG ratio. So that is the one thing that I ask you to calculate, and it's pretty simple. You just take the PE and divide it by the growth rate without the we learned that in class 2 if you need a refresher on that. But yeah, the PEG ratio you wouldn't be looking at how much it's growing. You wouldn't want a PEG ratio to get higher because of course you want a lower PEG ratio. Okay. So yes, okay. You said a negative EPS is not a negative growth rate. No, they're not the same thing, because you can have a positive growth rate and a negative EPS. That just means that the company is not losing as much money this year as it was last year. So they're kind of two separate events. The EPS is a dollar amount and the growth rate is a percentage. So you're looking at how much the EPS is growing as opposed to looking at actually how much earnings per share that you have. All right, keeping in mind you always want to keep a plan B. What are your thoughts on the stock market tanks? Monique, if the stock market tanks, then we're buying. That's what we do. The stock market is way overdue for a correction, and like a good and one that doesn't bounce back again overnight. Right after, with my first round of students, opened in October, and then the election results came in about a month later, and the market was like super red. It tanked, and it was only red for like a couple, I think by the time it opened, and like by the afternoon, everything was moving back up towards where it was. So that wasn't, I mean, it was kind of a flash crash type thing, but it quickly recovered. So it wasn't really a real correction. A correction, we would want to see everything that is inflated and has really high valuations, really high price to earnings ratios and high PEG ratios. We would want those to come back down to earth and stay that way an extended period of time. So that's what we're hoping for, because we want to buy at lower prices, not higher prices. So I hope that makes sense. Love reading the comments and seeking alpha. Oh, and the other thing too is when share prices come down, if you have dividend reinvestment, which you are going to learn in class 8, that means your dividends are buying bigger pieces of fractional shares for you than if you have higher prices. Okay. Yes. Okay. PEG ratio of 1.1 to 1.9. Is that a good indication? Good indication of what? I'm not sure what you mean. A PEG rate or a growth rate? A PEG ratio or a growth rate? I'm not sure which one you're talking about. Is it? All right. In class 2, PE divided by EPS. PE is divided by growth rate to get PEG. Nicole, I'm not sure what you're talking about. But the PE divided by the growth rate percentage, that is how you get the PEG ratio. So it wouldn't be the PE divided by EPS, because PE already has EPS factored in. PE is the share price divided by the EPS. Make sense? I'm trying not to get turned around here. All right, PEG of 1 typically means that the company is valued fairly. If a PEG is under 1, that means it's on sale. Yes, Nargis. Yes, we all need a good crash. Do you think inflation is because more people are getting into the market? It could be. It's some of that is it. We have had prices has been inflated in part because of interest rates being held artificially low. And while they are rising slowly, they're really not rising by very much. When we see interest rates rise, that is when we will see prices come down because, and now I explain, there's a post in Mastermind if you want to search it. Just search interest rates. When interest rates are held low, that means that bond investors or other conservative type investors who are investing in bonds or keeping their money in CDs or in savings accounts, this means that they're not earning very much money on their capital that they have held in there. They're not earning much money on their money. So what do? They go to the stock market to invest in more stable companies to get better returns. So this for retail investors, and it's also true for a lot of fund managers. So fund managers, because their clients or, getting better returns than, 1% or 1.5%. And that's what you can get with bonds right now. So for fund managers, they will be a little bit more aggressive in their asset allocations in order to get the returns that their clients want. Floods the market with more money, which increases demand, and that pushes prices up. So once interest rates start rising again, then people can get the yield or the returns that they're looking for from more conservative investments. So they can be heavier in bonds and not have to have the risks that can be associated with the stock market. So then what happens when interest rates rise and bonds become more attractive? Fund managers and retail investors will pull their money out of the stock market, which means prices come back down because the demand is lower because people are selling. So I hope that makes sense. This is why our market has been flying high for what seems like forever, because these interest rates have been held artificially low for so long. So when the interest rates rise again, we will see a correction, and it needs to happen. It's kind of market manipulation to keep interest rates low like that, and they did it to help the economy after 2008, 2009. So, but it does need to happen, and it will happen. So as long as you're prepared and you know that will happen, and when you hear about interest rates rising, that means that there's probably going to be a market correction coming, then you cannot panic and you can actually buy stocks at good prices. So, okay, let's see what I missed while I was babbling. Okay, the PEG ratio in class 3, there was a question that the PEG was 1.1, which is 10% higher. Is that a good indication to purchase? So that means it's 10% overpriced, all else being equal. Now, if this is a high growth company that you've researched and you see nothing but great things happening for it, and it has little opportunity, it has few threats, lots of opportunity, and it is just seems overall like a great company, PEG ratio, you might make a decision to invest at that point before it pushes higher. And that would be an investor preference thing. And there's absolutely nothing wrong with that. Your PE ratios and your PEG ratios are guidelines. So that is telling you what is normal or considered mathematically a fair price, but there are so many other factors that go into it that could change that. So this is definitely where you start to become, once you learn all these concepts and what they mean, then you have to apply your own knowledge and use your own, kind of subjective, investor opinion to decide if now is the time to buy. And you'll learn a little bit later about starter positions, and that's when you open up a position at something that might be a little bit higher priced, and then you will slowly try to average down every time it kind of comes below that price. So there are definitely a bunch of different strategies you can use, but that's something that there's really no right or wrong answer to. Okay, let me see. Oh, what questions that I told you guys I hate this chat. Blackjack, who are you in real life? I don't know what. Let me see. Okay. How do you know if a company is growing at more than 20% a year? You look at the trailing growth rate. That's how you would know. That will tell you. Blackjack, I'm sorry. And I have seen that question before, and I don't know. I guess I didn't answer it. I'm sorry. PEG ratio in class, there was a question. Oh, okay, answered. Super low. If PEG ratio calculation come out to anything over 1, for example, that's still in, yes. So anything over 1 mathematically says that the company is overpriced. But like I said, there are a lot of other factors that can go into whether a company is fairly valued or not. Okay. Nargis is on it. I'm all late. Okay. Working, we'll have to review the video. Okay. How do you find the growth rate again to find PEG ratio? I thought we looked. No, you want to PEG ratio. If you look at your valuation cheat sheet, it shows you how to calculate everything. But most things you're supposed to just pull from Yahoo Finance. PEG ratio is the one ask you to actually calculate, because there are too many different factors that could there are too many different factors at play, including the fact that you may not just want to use the analyst's average for the PEG ratio down the road. Now, for a class, I ask you to do it that way because it's just cleaner that way. But in the future, you should definitely look at the analyst's estimate, and then you should also do your own research to figure out whether you think that estimate is fair, or if it's high, or if it's low, and just kind of gauge your opinion from there. So definitely read through. I didn't include the Procter & Gamble analysis in these earlier parts of class because it's a lot, and I don't want you to be bogged down with that. But definitely, if you want to look at it now, you can, but it'll make more sense after class 4 and 5. But you'll learn more about how to put all that stuff together if you look that over. Okay. Talk more about the Yahoo app and how to click through for the analyst information. Kimberly, I'll post a screenshot when we're done here. I'll post it in Mastermind. Trailing growth rate. Trailing PE and forward PE. Are you talking about the spreadsheet? It should have trailing growth and forward growth. We don't use a forward PE. I don't teach about that in this class. A forward PE, I don't want to confuse you guys, but we don't use a forward PE. We always use a trailing PE, and then we forward or trailing growth rate to find out the PEG ratio. So anything you see that says trailing, or anything that you see that says forward PE, we don't use that one here in class. I don't show you how to use that. It's not a metric that I use. Some investors do, and that's something that you could learn about later on if it makes sense for you. But I think it's just cleaner to use a trailing PE, and then if you want to look in the future, then use a forward growth rate. So, okay. Brokerage for custodial accounts. Earl, I don't know. I'm having a difficult time with that because brokerages, I don't know. I would love to say TradeKing, but there's that issue of funding that people have run into. Now, you can set up bank to do like a bill pay to your child's custodial account, and so that it can be automated. but you would have to do that on your bank's end because TradeKing will not allow you to set up an automatic transfer from your bank to TradeKing through TradeKing. So you would have to do it just from your bank and set up an automatic bill pay to your child's custodial account in order to make it automated. Otherwise, you'd have to just write checks and send them every time you want to do it that way, which I think is ridiculous and a pain. No other brokerage does that. I'm hoping now that TradeKing is Ally Invest that they will change that, but that is just a TradeKing thing. So and then Options House is much easier, but again, I don't know if I'm thrilled with that trading platform. So I would look at, I would probably look at Schwab and Vanguard to see, but some accounts, they do require a minimum, which is why I don't recommend those ones as regular practice. So that is something I hope to eventually have all my brokerages, all the tutorials and everything set up for those soon. It's just, there seems to be so much upheaval right now with different brokerages, like E-Trade just acquired Options House, and TradeKing was just acquired, and Scottrade was just acquired by another brokerage. And it just seems like there's so much competition that brokerages are being squeezed out, and it's hard to like grab just one that I want to use all the time for everything just to be consistent because there's so much different stuff going on. So I hope to have that figured out here pretty soon. But I guess it would be TradeKing if your bank will set up a bill pay to your child's account. Otherwise, Options House. Otherwise, you could look at Vanguard or Schwab, but I'm not sure about the minimums required for that. Okay. Growth rates on Yahoo Finance, use desktop. I'm positive, Nargis, about the growth rates with Yahoo. I'm positive that you can look it up on, like I said, I use Seeking Alpha for my own portfolio. And I have you guys use Yahoo Finance because it's easier to find your data. But I'm almost positive you can click through on the app and it'll bring you up to the desktop version to where you can look at that. So yes, TD Ameritrade is okay for custodial accounts, but it has that much higher trading fee. I think it's still at $10 a trade. So TD Ameritrade is what I recommend for custodial Roth IRAs because very few brokerages do those. But, and usually the brokerages that do them have the higher trading fee because that's like an extra service that they provide. But I wouldn't use it just for a custodial account because the trading fee is too high, which is why I'm having this internal struggle with which brokerages to recommend. So anyway, let me see, Fidelity. I'm not a fan of Fidelity. Maybe that's because my husband's 401k was through there, and I think their trading fee is a little higher too. But you know, it's really, your brokerage boils down to preference and ease. As well as cost. So I usually go with the most cost-effective ones, but then again, you know, it's just going to be up to you as far as how you want to use it, and you know, everybody's a little bit different on their preference there. All right, free trades for both my custodial accounts. Set up. Oh, awesome, Siobhan. I like to hear that. Okay. Oh, interesting, Angela. Okay. Okay. Custodial accounts for other children. You can do that if you have their social security number. You can set up a custodial account for most places. But then again, you know, kind of like Trade or Ally Invest has that thing with not being able to set up transfer to a custodial account. You may have some brokerages that won't allow you to do it if you are not their legal guardian also, but you should be able to, as long as you have your social, you can be the custodian on their account. So, all right, guys, I will talk to you guys soon. I'm going to encourage everybody to, if you need to review class 3 again, do so. And get through class 4. Class 4 is longer. It's like 2 half-hour videos, and I really tried hard to cut out what I could. That was because sometimes I start to repeat myself because I'm really excited and I just want to make sure you get it. So I really tried hard to pare those down to something more manageable, but they're still about a half hour each. So give yourself some time to get through those, but you do have an entire week to get through class 4 and review class 3 or review any other parts you want to, because this is pretty much class 4 and 5 is where it really all comes together, and you pretty much learned all the hard stuff, and the rest is just details like learning how to place a trade, and you get to look at my portfolio, and it's just like some little details like that. So really the thick of it, once you understand forward and trailing growth rates and calculating the PEG ratio, you're really on to like I said, just the details, and you're going to be choosing your own stocks. So yes, I'm very excited for you. You guys are doing awesome. You have like all the right questions. You are on the right track, and we are, really we're halfway through technically, but you're almost done learning what you need to know. So congratulations. All right. Thanks, guys. I'll talk to you later.